So basically inventory is what? Inventory is nothing but stock. Okay. This is nothing but the merchandise stock, we can say, which every business, which a trading concern purchases from the wholesaler, manufacturer, dealer to sell to customers. Okay. So if there is a retailer who is buying the goods from wholesaler to sell it to customers, here he is buying and here he is selling. It's a trading concern and he's selling to customers. So what he is dealing with is nothing but inventory or stock or merchandise inventory, merchandise stock. Okay. Now coming to inventory, see, when you are studying the analysis of any particular item of balance sheet. So inventory is one of the items of balance sheet which we show in the balance sheet usually. Okay. So whenever you are dealing with such kind of topics, that topic is dealing with standards. Standards here means accounting standards. What is a standard? Standard is a norm to be followed always, or a benchmark. Benchmark is nothing but something which is to be followed at any cost, and if you follow that, you will never make mistakes. A small example, if Mr. X wants to become a bodybuilder, he wants to build his body and he wants to, you know, make his physique and all, he wants to have that physique of a bodybuilder. He joins a gym and he sees some very renowned, bodybuilders around the gym. You know, all the gyms are filled with all these photographs. Sylvester Stallone, Arnold Schwarzenegger, or if he wants a lean physique, John Abraham, what we say. So what this guy does, this guy, it's not only seeing the photo would make his physique like that. He has to follow that regime, that particular kind of workout he has to do, that particular standards he has to follow what they have followed to make themselves. So if he follows those standards, he will definitely achieve that feat, or he'll get what he desires. Okay. In the same way, standards are very important to be followed any point of time. If you follow standard, if you follow benchmark, you'll never go wrong, you'll never make mistakes. In the same way, if you follow standards and give accounting treatments to items of income statement and balance sheet, it is understood fact that you'll never make mistakes in giving those treatments, because the accounting standards are prepared with thorough research, thorough analysis of all the issues involved in preparation of standards, and these are the ones which are accepted by entire world for accounting practices, by different law making bodies of the countries. In India also we have companies law which asks you to follow Indian accounting standards to prepare the financial statements. Like that, we are here dealing with IFRS, International Financial Reporting Standards. Previously it was IAS, International Accounting Standards, and now now they are making the revised version of this, which is IFRS. This is prepared by IASB, International Accounting Standards Board, and then there is FASB, Financial Accounting Standard Board, making US GAAP. These are the two standards which are ruling the world or followed in entirety. Almost all the countries of the world would like to follow these standards. If they have their own standards, despite of that, multinational companies belong to these countries. So the standards are always in trend and always in demand. So now, what does this standard do? What does a particular standard does? What does a particular standard do? How it helps you? How it helps the user? So let me take here a small example. So if I take first and foremost thing, if I take IAS 2, International Accounting Standard 2 deals with inventory. Like that, US GAAP also may have its own standard. Give me a second, I'll just have some water and come. So this particular standard deals with inventory. Inventory, see, many of you, even when you used to study in your graduation days, okay, your teacher used to say to put this inventory in which side of balance sheet, asset side of balance sheet. And you used to put that in the asset side of balance sheet. But my question is, why are you putting that in the asset side of balance sheet? What's the valid reason for that? I will say, sir, it's an asset. That's why we put it here. How come you know this is an asset? What makes you to understand this is an asset? Any answer? Please tell. Any answer to my question?
By if we sell that, we'll get income. By in it is an exchange for money. So
Yeah, you are somewhat near to this. Okay, you are very very near. Just a second. Just a second. So you are saying that inventory would give you some profits. Am I right? So I would rather I would use a good terminology for this. You're near to that. So if I want to show something in the balance sheet as an asset, the first and foremost thing is that particular resource which I want to show in the asset side of balance sheet should match with the definition of an asset. So now I come to my main topic, IAS2. This particular standard, if you follow, what you come to know about like inventories, as you know, IAS2 deals with inventory. What information or what guidance IAS2 gives you with respect to inventories? It shows you how to recognize inventory. So I will say first point, recognition criteria. Then it tells you or gives you guidance regarding how to measure this, measurement basis. Then there are a lot of information which you cannot write on the face of the balance sheet. Those information need to be disclosed in the disclosure column, which comes after preparation of financial reports under the footnotes. Okay, so this is a financial report. When we prepare a financial report, there is footnotes in that we need to disclosure. Okay, because not every information can be shown in the financial statements. You can write about inventory and its value. Okay, that's what writing inventory is, recognizing inventory. What am I recognizing inventory as? Asset. I'm putting it in the asset side of balance sheet. Why am I putting that in the asset side of balance sheet? Because it fulfills my recognition criteria. But what is my recognition criteria? I will recognize inventory as an asset. Why? Because inventory is such a resource, okay, which is owned by the company. Fine. If I speak about a sole trading firm, okay, owned by the sole trader, controlled by the sole trader, and if the sole trader sells this to other customers, in future he is going to make economic benefits out of it. So that economic benefits is going to enjoy. So that's the reason why I can say that inventory is an asset for a sole trading firm. When it comes to company form of organization, of course, inventory is a resource which is owned by the shareholders. Yeah, yes, because shareholders are the owners of the company, controlled by the entity or company, and when they sell the inventory to customers, they will make future economic benefits. That benefits company will give to whom? Shareholders. So in this way, they are also making benefits out of or profits out of this particular inventory. Henceforth, what the point here is, first and foremost point is economic benefit. Second is it has a cost. Its cost should be measured reliably. What do you mean by cost should be measured reliably? See, everything which you want to show in the balance sheet should have a cost. Point number two. For example, there are five people who are working in my company: Ramesh, Suresh, Abhishek, Ravi, and Akash. These are the five people who work in my company, let's say, and these are very valuable human resources of my company. But can I show their value in the balance sheet? Ramesh 1 crore, Suresh 5 crores. I can never show. Why? Because human beings are invaluable. Their services can be valued, but they cannot be valued. But inventory, which is a product which we are going to sell to customers, we are buying from suppliers and we have paid some price to buy that inventory from suppliers. Hence, it has got a cost. Okay. The cost what we have incurred is cost for us, but it is selling price for the supplier. So it has a cost. Henceforth, when it has got a monetary cost, definitely it can be shown in the asset side of balance sheet. So the point, first one is very clear: recognition criteria. First, it should give you economic benefits. Second, it should have a cost. Okay, so point number one is cleared. Point number two, measurement basis. How are you going to measure the inventory? That means you are going to show it at some value, right? You are going to show inventory at some value. Of course, at some value you're going to show. Now, what is that value at which you're going to show the inventory? Are you going to show that inventory at cost price? Are you going to show that inventory at selling price? Are you going to show the inventory at NRV, net realizable value? That is nothing but selling price minus cost of disposal. See, what is this selling price minus cost of disposal? Suppose I want to sell some inventory to someone for 100 rupees, and the expenditure what I'm incurring to sell this, I'm hiring some agent and he's charging a commission of 10 rupees from me for one particular item. So 90 rupees is what I'm getting net in my hand. This is my net realizable value. That is selling price minus cost of disposal or cost of selling that particular item. So now at what price I shall show the inventory in my books? Cost, selling price, or NRV? This definitely is an important point. You are confused regarding this. Don't worry. The International Accounting Standard 2 or the standard which is followed in the US GAAP will help you to really understand at what price you should show that inventory in your books. Okay, that is measurement basis. And third, some information which cannot be shown in the books definitely cannot be hidden. Of course, everything should be very transparent because company belongs to shareholders and everything has to be shared to shareholders, all the information. So any information from whom you bought the inventory, what is the quality of inventory, how much inventory you have purchased, how much you are selling, what is the method of valuing the inventory, LIFO, FIFO, whatever, every information should be disclosed. That is, additional information should be disclosed. So third comes the disclosure requirements. So a particular standard, if you study, whether it is any standard, here my agenda, my topic today is with respect to inventory. Tomorrow I may start a topic related to tangible assets. There is a standard related to that which helps you or guides you how to deal with tangible assets, how to give treatment to tangible assets in the books of in the in the financial reports. Okay, then there is intangible asset. There is a separate standard which deals with intangible asset. It again gives you guidance how to recognize intangible assets, how to measure intangible assets. That means at what value it should be written in the books, and then how and what should be the disclosure related to intangible assets. Like that, you will be dealing with lot many assets and some liabilities, and standards are there to give you proper guidance related to treatment of those particular items of either income statement or balance sheet or statement of financial position. Okay, now let's move to the topic. If you want to note it down, please note it down. I'm giving you time. Okay, once done, tell me please. Okay. Now, let us start the topic with some good points. Okay. What does it show? First of all, we'll discuss what is COGS. Any clue what is COGS? Any one of you? Yes. What is COGS? COGS is cost of goods sold. Yes. So what does this cost of goods sold say, or like what is the importance of this? So first, if you want to find out the gross profit of a company, okay, you have to deduct the cost of goods sold from the sales or revenue. So see here, revenue, also called as sales. Let's say it is 12. Let's say I bought, let's say, okay, I'll give you a detailed knowledge regarding this. Let's say I bought 100 boxes at the rate of $10. Okay, I bought 100 boxes at the rate of $10. Okay, and this is my cost. I want to sell 100 boxes at the rate of $12. This is my sales. Okay, so now revenue 100 into 12 is 1200. Okay, let's say all the boxes which I have bought here, I'm selling it. What all the boxes which I bought here, I'm selling it. There is no closing stock, no closing inventory, no leftover inventory. Okay, the entire inventory which has been purchased is sold. Now, COGS, cost of goods sold. Formula, opening inventory. In my example, there is no opening inventory dash. In my example, there is purchase. Yes, there is purchase. How many boxes I purchase? 100 boxes. At the rate of what? $10. Right? And see, we have to deduct the closing inventory. Now, you will be asking a question to me, sir, why shall we deduct the closing inventory here? I will explain you. Don't worry. The point here why we are deducting the closing inventory is the inventory which we are not selling, or the inventory which is left over with us, we are not going to compare the cost of that inventory with the inventory what we are selling. In the sense, now I'll give you the clarity. So closing inventory is nil. So here you understand, I bought 100 boxes, I'm selling it at the rate of 12, and I have I'm selling 100 boxes at the rate of 12. I'm generating a revenue of $1,200. I bought 100 boxes at the rate of $10. It costed me $1,000 entirely. So I am comparing the cost of 100 boxes with revenue of 100 boxes to get the profit for 100 boxes. Am I right? Yes. 200. This is gross profit for 100 boxes. So there is no rocket science. I purchased 100 boxes and I purchased 100 boxes at the rate of $10. The entire expenditure was of $1,000 for me. I sold these 100 boxes which I purchased at the rate of $12 to my customers. I generated a revenue of $1,200. Now my revenue is $1,200 for 100 boxes. My cost is $1,000 for 100 boxes. Then my profit is $200 for 100 boxes. Till here everything is very clear, very simple, right? Now let's say, let's change the case. I bought 100 boxes at the rate of $10. I sold 80 boxes at the rate of $12. I purchased 100 boxes. I sold 80 boxes. 20 boxes are left over with me. 20 boxes are left over with me. This is my closing stock or ending inventory, whatever you want, you can say. Okay. Now I want to find out the profit from this transaction. So I will take revenue. Now you tell me revenue should be for 80 boxes or 100 boxes?
80.
80 boxes. So 80 into 12, 960. Now cost of goods sold. The cost should be for 80 boxes or 100 boxes?
100.
Why 100? You are selling 80. Can you compare 100 boxes cost with 80 boxes revenue? Does it make sense? No. When you are generating revenue for 80 boxes, you should compare the cost of those 80 boxes with the revenue of 80 boxes to get the profit for 80 boxes. Okay. That is what you should know. So whenever you generate revenue, you should see for how many boxes you are generating. Accordingly, the cost also should be taken for those many boxes only, because as per the matching concept, you should match the revenue with its cost. So the revenue here is for 80 boxes. So the cost should also be for 80 boxes. So now see, opening inventory is nil, purchases. How many boxes I purchased? Of course, 100 at the rate of $10 less closing inventory, 20 boxes. I did not sell. It is left over with me. So I will remove that 20 boxes cost from the 100 boxes cost to get the 80 boxes cost, which is 80 at the rate of 10, 800. So now my profit for 80 boxes is $160. This is what we do. And students, what they do is they mug up the formula. Don't mug up the formula, understand it. Please make a note of this, please, fast. We have to enter into the next topic. Done. If you are done with, please inform me. I'll move forward. All of you finished? Okay, let's move forward. Why no one is saying, no one is giving an answer to me? Are you able to hear
Yes.
my voice? Am I audible?
Yes, sir.
Yes, sir.
Okay, okay. Okay. Now let's understand some points. First and foremost thing is we discussed right now, right? How should the inventory be valued, right? My question was how shall the inventory be valued? So now write on this point, inventory as per the International Accounting Standard 2. Okay, inventory should be valued at lower of cost or NRV. Write on the point first. I'll explain.
Cost of NRV, right?
Yeah, NRV.
Okay.
Now we shall understand, see, we shall first understand this particular rule, lower of cost or NRV. Okay, let's go ahead and see with a very good example. See, cost is the price at which you purchase the inventory. Let's say it is $100. NRV is the net realizable value. Let's say the net realizable value is $30. Now you tell me the inventory which you purchased for $100 today is giving you $30. So what makes sense? Will you show the inventory at $100 or $30? What makes sense is you should show the inventory at $30. Why? Because something which is of $30 shouldn't be shown at $100. That will be overstatement of the value. Are you understanding? Something which is giving you $30 if you sell should not be shown at $100. Okay, that would be unjustified. Why? Because something which has a value of 30, okay, you should not be showing that at 100. When you go to a shop and someone shows you a particular inventory which is or stock which is old stock, you will not be ready to pay this amount to them, you will be ready to pay this amount to them. So it is wise or prudent for them to only show the inventory for the value which it can fetch them, or the value which they can get out of that inventory. Okay, not something which it has been bought for. It has been bought for 100, but it is giving you only 30. It doesn't make sense for you to show it 100 because it is not realistic. So what you can do is you can show the inventory value at 30 and you can show a loss of $70 loss from inventory in the statement of profit or loss, or you can show it under the COGS. Okay, so what treatment you are giving is you are showing the inventory value at $30, the leftover inventory. We are speaking about the ending inventory, closing inventory, leftover inventory. and you should be showing the loss of $70. Fine. This is now this particular thing justifies the rule lower of cost or NRV. Here the cost is 100 and the NRV is $30. The lower amount is $30 and we should show at $30. Understood fact and clearly understood. Fine. Please make a note of this. We'll go for the next example. Next point. Okay. Now we will see the another case. This was like when the cost is 100, NRV is 30. Let's say the cost is 100 and NRV is 150. Then what do you see? See, ending inventory is leftover inventory with you, right? Now you are going to sell that in the future. Something which you are going to sell in the future is going to give you or generate revenue for you in the future. Yeah, you are thinking to sell that at 150. I understand. Or you're going to get 150 in the future, not today. Today, what you have the inventory is how much value it is having. It is having $100. That is the future value you're going to get. This is the present value which it has. What makes sense? What is prudent? What is wise? Don't show something which you have today at its future's value, because this amount you haven't got yet today. So here also you are going to show the inventory at $100, that is lower of cost or NRV. Tomorrow when you sell this inventory, you can show 150 as your revenue in the books. Fine for that inventory. But something which you haven't sold, you cannot show that inventory at selling price today. You have to show that inventory at cost today. So again, lower of cost or NRV and the lower value is $100. Okay. Please make a note of this also. And let's do a question based upon this right now. If you have written this, I'll show the question to you. You have to solve. Shall we move forward? Yes.
Yes.
Yes, sir.
Okay. Solve this question. Let me see what you're doing for this. Come on, all of you. The question is in front of you on the screen. Okay, so Zoom Inc. sells, I'm not getting any answer from any of you, so I'm just going for this question. Zoom Inc. sells digital cameras. Per unit cost information pertaining to Zoom's inventories as follows. Original cost is this, estimated selling price is this, estimated selling cost is this, NRV is this, replacement cost is this, normal profit margin is this. Okay, so you have been taught only this one till now, not lower of cost and cost or market. I will explain you this after doing this particular thing. Okay, so let's understand how to do this. First, lower of cost or NRV. What is NRV? NRV is equal to 203. Okay, and what is the cost? 210. So you will be showing the inventory at what cost, right? And the inventory should be written down. See, you're showing the inventory at cost, right? That means you're not showing at this. You have to write down the inventory value. Okay, so using the lower of cost or NRV, because the original cost 210 exceeds net realizable value, your cost is 210 and your NRV is 203. Okay, I'll write it here and otherwise you'll be confused. Your cost is more, your NRV is less, so there is a loss of how much? Loss of how much?
7.
Yes, $7. So that loss you should be recognizing. You will be showing in the income statement. Okay, loss from inventory. So that's what they're saying. Using the lower of cost or NRV, because the original cost, which is 210, exceeds the net realizable value, that which is 203. That means your cost is more and you're getting less from the market. So there's a loss of $7 which you have incurred, which you have to recognize. Okay, and you tell me you will be showing the inventory at what value? At 203. Why? Lower of cost or NRV. As 210 was the cost, you have removed the losses from it and you are showing the value of the inventory at 203 right now. Yes, because you have to show the inventory at 203 only. Why? Because the rule, the rule of the rule or the standards say you should always show inventory at lower of cost or NRV, lower of. So the lower value amongst these two is what? 203. That's what. But how you got this lower value? Because of a loss? which you incurred of $7. How and why? Because the cost is more and the value which you are going to get after selling this is less. So you are incurring a loss of 7, which you have to recognize. Okay. So what we did is we took the cost, we have written down the value of this, and we have bought the value to 203, and we are showing the inventory at this value and also recognizing the losses. Done? Any doubt? Please tell.
No.
No, sir.
Okay. Now we will go for the second one. Okay. Try to understand. So to understand that, we should first do some background check. We have to now read this value under US GAAP. See, one more thing I will say, IFRS, sorry, International Accounting Standards, US GAAP. We have understood that $100 cost, and now the inventory is giving us $30. We can recognize a loss of 70. We also studied that if the inventory is of 150, okay, then what? Then there is a gain of 50, right? Correct or wrong? This is called write up. What is this called? Write up. Write up is only allowed in case of international accounting standards, not in case of US GAAP. US GAAP only recognizes write downs. Okay. So here we'll see. Under IFRS, that is International Accounting Standards, inventory is reported on the balance sheet. Whatever inventory you show in the balance sheet is nothing but your closing inventory or your ending inventory at lower of cost or NRV. NRV we have already discussed. NRV is less than the balance sheet value of inventory. Inventory is written on to NRV. We have discussed right now. Loss is recognized in the income statement. We have discussed right now. If the value of the inventory recovers later, now again you should understand. Let's say the inventory was of $100. Okay. Leave this case. Leave this case. You'll be confused. Leave this case. Okay. Inventory is of $100. It has become $30. Okay. You have shown a loss of $70. What they're saying is, if the value of inventory recovers later, let's say due to very high demand, this inventory value has gone up and now people are ready to pay $120 for this inventory. So now the previous loss of 70 has been recovered, right? Yes or no? Now you are getting a gain of how much? 90. From 30 it has gone to 120. Not 90. Yeah, 90. So now the previous loss of 70 can be written off. Okay, see, can be written off in the sense the loss has been recovered right now. Now you have an excess gain of $20. Come on, tell me yes or no.
Yes.
Yes, sir.
So because the previous loss of $70 which we incurred now has got recovered because the inventory value has gone up to 120. People are ready to pay 120 for this inventory because of excess demand. So the previous loss of 70 is not there right now, and we are getting excess money for this, right? We have recovered the previous loss and getting more. So if the value of inventory recovers later, the inventory can be written up and the gain is recognized in the income statement as a separate line item or by reducing COGS by the amount of recovery. So if already you have recognized a loss of 70 in COGS, you can remove this loss by adding 70 to COGS. Why? Because you have recovered it. Now, because inventory is valued at lower of cost NRV, and now one more thing. Inventory cannot be written up by more than it was previously written down. You cannot write this 20 gain. That's what I was wanting to tell you. I just took the example purposefully to show you that 120 is the value now you're going to get. But remember, you cannot show that at 120 in the sense. Now, see the NRV is what? 120, right? but you cannot show a gain of extra 20 here. You can only recover the previous loss of 70. That's what the standard says. Did you understand now? Yes.
Yes, sir.
Yes, sir.
So the loss which was previously written down was $70, and now the recovery has happened, and the recovery has happened to $90, I understand, but you can only show that loss recovery of $70, not more than this. That's what the standard says. Okay, you cannot show that. Now, why you cannot show that? My question again. Can anyone give the answer to me? I am putting this neatly here. See, I'm again showing this example. $100 inventory gone to $30, loss of $70 recognized in COGS. Okay. Okay. Now the inventory value has, this is like 70 loss. Now the inventory has recovered in value. It has gone to 120, and my recovery is of $90. But the standard says you cannot show, you cannot show that you have recovered a loss of more than $70. Why? Anyone? Please participate. Anyone? The answer is there in the rule itself. What does the rule say? What does the rule say? The rule says you have to always show the inventory at lower of cost or NRV. Even though my NRV is 120, I cannot show the inventory at 120. Why? Because I have to show that at 100. Why? The NRV is 120 right now. After recovery, the cost is 100, and the lower value is what?
$100.
So if I am going to show the inventory at 100 only after recovery also, then how much maximum I have recovered? 70. That's why I cannot show that extra 20 despite of my inventory going to 120. In this case also, the lower of cost or NRV was applicable, and I showed at 30 and showed a loss of 70. But now my inventory value has got recovered. My inventory value has gone up to 120, but still this is my NRV, this is my cost. I have to show it cost only because this is lower than this. So I can only show that I have recovered a loss of 70 because I'm going to show 100 in the books. Okay, not 120. Fine. Let me give you a valuable input of information. No write-up is recognized in US GAAP. They only recognize write-downs. That means if the value goes down, the losses can be shown, but recovery element is not there in their concept. Make a note of this fast. Everyone is active, right? If I am not wrong, I'm able to put everything very clearly to all of you.
Yes, you are.
Okay, now let's do that last part and wind up for the day. Now, under US GAAP, companies that use inventory cost methods other than LIFO, see, there are, now you will be like seeing some methods here. So there are certain methods of valuing inventory or finding out the COGS or ending inventory value. See, every company wants to know what is the value of their closing stock. You have made final accounts here, inter, you have made the financial statements in your degree, so you have got all the information with you directly, closing stock, COGS. But no, the cost accountants of the company find out the value of closing stock and COGS, and they give that information to the financial accountant. Because inventory is something which is not, you are only buying at the end of the year and selling at the end of the year. You buy from the day one of your calendar year when you start your business. That means Jan 1st. You go to DMart and see the inventory in DMart, what level of inventory they are maintaining, or Metro Cash and Carry, National Mart, whatever. You see thousands of lakhs of items and they get inventory in layers. So then they should know certain methods to find out the value of COGS and ending inventory if they get inventory in layers every year. So there are certain methods like FIFO, LIFO, AVCO, average cost method. Okay, average cost. AB is average, CO is cost. LIFO is last in, first out. FIFO is first in, first out. Okay, these are the methods which are followed to find out the values of cost of goods sold and ending inventory, at which you are going to show the inventory in your books. Now, coming to the methods. LIFO method is not to be used under international financial reporting standards. That means if you are using IAS or IFRS, LIFO method should not be used for inventory valuation. That is banned here. US GAAP doesn't ban any method. You can use all the methods. I will give you the reason why it is banned as per IAS or IFRS. That valid reason I'll give you afterwards. Don't worry. As per US GAAP, you can use any method for valuing inventory. Okay, but rules would differ based upon the method what you're using for inventory valuation. That we are going to study right now. Come on, let's understand. So under US GAAP, companies that use inventory cost methods other than LIFO or retail method. So there's one more method you are learning right now, retail method. Generally, we are not going to use this. That means they are saying if the companies are using other methods and not LIFO and retail method. Okay, except these two methods, if they are using other method, which other method then? FIFO,
FIFO and average.
AVCO. They can use the rule lower of cost or NRV. Make a note, please. Sorry, very untidy work I have. Okay, don't mind. Note it down. If the company is using other methods like FIFO and AVCO for inventory valuation, but not LIFO and retail method, they have to use this same rule of lower of cost or NRV. Now the question, if they use LIFO and retail method, then what? I will explain you. Okay. Next question is, if LIFO or a retail method, then company is going to use lower of cost or market. Okay, previously what you have seen, lower of cost or NRV, but here lower of cost or market value. What is this market or designated market value? What is this designated market value? Okay, in this you have to take three terms, three things, and middle of that you have to consider. So what is that? Market is usually equal to replacement cost, but it cannot be greater than NRV or less than NRV minus normal profit margin. So I will take this. You have to take NRV. You have to take replacement cost. You have to take NRV minus normal profit margin. These three things. Okay. Replacement cost is what? Let's say you have a mobile phone. You purchase for 20,000. and after 5 years it has become now you want to change this mobile phone which you bought today. 2024 you bought a phone, 2025 you want to change, 2029 you want to change this after 5 years. You'll go to shopkeeper, you'll tell them that I want to replace this phone. They'll say that okay, no problem, you pay us you pay us 18,000 rupees, okay, and you give us the mobile phone as well. You are giving your instrument and you are giving cash to the shopkeeper. That means they are giving you how much replacement they are doing for you of value? Tell me.
2,000.
2,000. Okay, that is replacement cost. So replacement cost is how much for you? 18,000. How much is replacement cost for you?
1,000? 18 minus 20 minus
No,
18?
18,000, right? 2,000 is what they gave you the money. You kept it in your pockets, but what is the cost you incurred?
That's 18,000. Okay.
That is what you paid, right?
Yes.
So NRV would be some X value, okay, some $100, let's say. Replacement cost would be $300. NRV minus normal profit margin, the data will be given you, will be $200. The middlemost value of all this will be what? $200 as per my example. This is your market value. Let's say your cost is 100 and your market value is 200. What is lower of this? 100. This will be your value. This will be taken as the value of your inventory. Okay. Please make a note of all this. We'll do the question fast. You have all the liberty to ask whatever doubts you have between. You can pause me and ask me. No problem. Please involve yourself in every class. Okay. Okay. Let's do the question. So your cost is 210. Your NRV is 203. Your replacement NRV minus normal profit margin. So this is the cost. NRV minus normal profit margin 203 minus 12. How much is that? Can you tell? 191.
190.
Yeah, and your replacement cost is 197. So I'll write it neatly here. 210, 203 minus 12, NRV minus normal profit margin, original cost, and 197 is your replacement cost. The middlemost term is what, and this is what it is coming here, 191. This is the lowest, this is the highest, this is the middlemost term, replacement cost. That's the reason why the book says usually it is replacement cost, because it cannot go more than it cannot be more than this, or less than this. I'll show the statement. Market is usually equal to replacement cost, but it cannot be greater than NRV or less than NRV minus normal profit margin. Okay. So now just a second. We wrote what formula we wrote here? Sorry, not original cost. NRV. Okay, sorry. That's what I'm saying. It cannot be more than NRV or less than NRV minus normal profit margin. It cannot be greater than NRV or less than NRV minus normal profit margin. That means it should be between them. It cannot be greater than NRV or less than normal profit margin. Okay, I'll change the stance. I'll put it here. This is the middlemost value should be there, right? What shall we put? 150, less more. That's what it says. They say it cannot be greater than NRV. We have to change the equation again. Where is that? Market is usually equal to replacement cost, but it cannot be greater than NRV or less than NRV minus normal profit margin. So your market value cannot be more than NRV, okay, or cannot be less than NRV minus normal profit margin. Usually it is equal to replacement cost, they are saying. So market value is what we will take. It cannot be more than NRV or less than this. So it should be less than this, cannot be greater than NRV. So if I put 80, generally we don't go with this rule, we always go with the middle rule only. If replacement cost exceeds NRV, then market is NRV. Okay, you just put this rule what I said. Okay, middlemost value rule you put always into picture. Okay, let's say this is $300, you put middlemost value rule always. The middlemost value is this. That is what we always follow, because I also give US GAAP classes and I know the proper treatment of this. I will prove that to you here, don't worry. See, what is your NRV? Again I'm changing. NRV is 203. Because the rules are clear. NRV replacement cost and NRV minus normal profit margin. So this is your NRV. What is your replacement cost? Not original cost.
197.
197. Yeah, sorry. Just wrote it there, got confused. And what is NRV minus normal profit margin? 191 we calculated, right? What is the middlemost value of this? Usually we got replacement cost only, right? Yes?
197, yes.
Yeah. Now we will try to see the rule what they are saying. And the answer is what? Answer is, this is the market value. Market value is 197. And what is the original cost you have? Original cost is 210. So this is original cost. This is the market value. Your market value is less than your original cost. So you are incurring a loss of how much? $13. Okay, and you have to show the show that particular inventory at what value? 197. Okay. Now this is proved and answer is also done. What they say, we will try to tally. Market is usually it cannot be greater than NRV or less than normal profit margin. Market. So market value is, yeah, market value we got is 197. It cannot be greater than NRV or less than normal profit margin. Is this point proved here, please? Your market value cannot be greater than NRV and cannot be less than NRV minus normal profit margin, and it is usually the replacement cost. Is it proved or not? Please tell me. What is your market value? 197.
197.
Is it greater than NRV? No.
No.
Is it less than NRV minus normal profit margin? No. That means it
No.
is between NRV and NRV minus normal profit margin.
Yes.
Yes. Right? And it is usually the replacement cost. So this is a proved point. Okay. Fine. So today, whatever we have covered, please go through this. The video is already there here. The video will be there in this. Tomorrow we will take a step forward and try to finish this inventory by tomorrow. Fine. So again, please re-review and go to this once again. Okay. Any doubts, please put to me tomorrow. Thank you.
Okay, sir.
Thank you. Thank you all of you. Thank you.